Welcome, everybody, to our VA webinar, trying to help people understand the benefits in an hour. So let's dive right in. We're fortunate to have with us Dave Oliverio today, a seasoned expert with over 30 years of experience in mortgage banking. Dave currently serves as the branch manager for New American Funding, recognized as a top 1% loan originator nationwide. His deep knowledge of real estate financing and credit intricacies makes him a respected authority in the field. I can personally attest to Dave's exceptional expertise, having worked with him on multiple refinances. Currently, he's got me approved for a loan if I ever find a house to downsize to, which I'm not sure. I'm going to hold my breath on this one. And also has had two successful transactions with my oldest daughter who lives in Montclair on purchases. His meticulous attention to detail, professionalism, and dedication are unmatched. Dave is also a highly regarded instructor with Cindy Bishop Worldwide, known for his ability to make complex topics easy to understand. Both agents and consumers consistently praise his teaching, as reflected in the thousands of positive feedback surveys we received. So we're thrilled, really thrilled to have him lead the session today. Let's get started. Dave.
All right, Cindy, very, very kind words, and thank you. And we do teach a number of we do teach a number of courses, continuing education courses for Cindy. Most of them are 2 hours, and as a matter of fact, we have a VA 2-hour class. So for this class, we're just going to essentially focus on the differences, where there's more flexibility when dealing with the VA Veterans Administration, say, versus Fannie, Freddie, or FHA. So we're going to bring those up to you. In general, our goals are the same. Every class that we teach, the goals are the same. Enhance your value as a professional in real estate, make your relationships stronger with your current clients. And I've said this many times, if we could come up with some ideas in these classes that will trigger new business for you, then that's when that's when we're most happy, quite frankly. So if we can come up with some ideas in some of these classes, and some of them we have come up with ideas that did trigger new business for the agents that attended. So it has happened, and hopefully it can happen today. It doesn't happen in every class, of course. So at any rate, let's just take a look at this. And Cindy had mentioned, and I think makes some sense, that there are a fair number of agents in the area, maybe because they don't understand fully the benefits of a VA, that shy away from the VA. And of course, there's some decent reasons why some do. But we're going to bring out some of the highlights in this next 45 minutes to an hour. So our goals today is to understand the importance of VA financing, today's housing market, how to help more people purchase homes using the VA home loans, understanding the benefits of the VA home loans. This is the neat thing too, especially it doesn't affect most of our area. The Northern Virginia area really didn't impact, but VA a few years ago came up with the policy that if an active service person or a veteran has full eligibility nationwide, non-high cost area, high cost area, VA has no loan limit. So you could be in Orange County, Virginia, you could be in Southern Virginia, have full eligibility. And if your lender is willing to loan $2 million zero down, VA's fine with that. So that was a change not too long ago, probably in the range of 2 to 3 years ago. Time is flying by on us, but that just helps in all of these non-high cost areas. See, at the moment, if you have partial eligibility, you're looking 766,550 as of January 1. That'll go to 802,650. but at the moment, 766,550. But so that's the good news. This summer we closed the VA loan. It was like almost a 2.5 sale price. Our veteran did put 10% down, so it was like a $2.5 million loan amount, but ratios, not great. When I say not great, meaning high, obviously putting 10% down, having high credit scores helps, but there is a lot of flexibility when you can, if it happens, $1.5 million, no money down. Okay, 2 million, no money down. Assuming they could afford the monthly payment, that's pretty, like I would say, that's more than flexible. So VA does not limit the maximum loan amount. Lenders limit the maximum loan amount. Ours is general with no money down. In general, 2 million. If it's a great case, we'll go higher than 2 million with zero down. So really will depend upon your favorite lender as to what the maximum loan they will provide. VA's got no limit. And we're not going to dig into the guarantee, but the reason in general, the reasons that lenders are going to do zero down to 2 million, because bottom line, if the loan defaults, which nobody wants to see that happen, VA is going to guarantee the lender 25% of that 2 million. So this is why lenders are willing to do zero down loans, because essentially they're protected by the Veterans Administration, by that 25% guarantee. So the lender's not on the hook for 2 million, but no lender wants any loan to default. But that's why lenders are, in general, more forgiving when it is a VA loan. And we'll get into that in the next slides. But when I talk about more forgiving, just more flexibility in terms of credit, in terms of ratios, in terms of debt to income ratio. Okay, so we're talking about last year, 1149. I don't think that's going to change, but I do think the 766,550 to 802,650, that will happen January 1 with partial eligibility. Okay, so these are some of the things that I think that a veteran or an active service person may miss. At least this is what I've seen over the years. If a veteran, especially, will have these military people that'll be in these non-high cost areas. They'll buy a home, no money down, 300,000, 400,000. And then they'll move to our high cost area. Many of them don't believe they could use their VA entitlement when there is plenty of entitlement to use at zero down in this area. And in the next couple of slides, we'll go over some examples. So that's where I see some opportunities. As we know, military people do get transferred. Many of them come from non-high cost areas, and many of them believe, hey, we're done because we've got that 400,000 sale price with no money down. We don't have any remaining entitlement, so we cannot use our VA again. That's somewhere where I think you could educate them and let them know that, yes, you are eligible. I think we all know this must be purchased as a principal residence. That's in general, principal residence within 60 days of settlement. And there's some flexibility with deployed services, retirees. VA's worst case is you got to be able to show worst case, and that's if they're deployed or retiree, that they're going to occupy the property in 12 months. In general, just like Fannie, Freddie, they want the veteran or the active service person to occupy, and within 60 days of settlement. Okay, these are some of the examples that when I was referring to, okay, non-high cost area, then, but So we're focusing right now on non-high cost areas with no money down. Okay, so this scenario, the vet previously used 36,800. Say they purchased a home, they used 36,800 of their entitlement. They're not in a high cost area, so they're somewhere like south of, say, Spotsylvania County, uh, or west of Clark County, and we're still in Virginia, so not in a high cost area. Formula, okay, in a non-high cost area, if you take 25% of the 766,550, so the formula would be 191,637. That's 25% of the 766,550 minus what they've used, and that equals their remaining entitlement. Times 4, that means in a non-high cost area, if they've used some of their entitlement, so you subtract the 191 from whatever they used, what it equals times 4, that's a no money down. So in a non-high cost area, they could literally do 0 down to a 619 sale price with already having used partial entitlement. So this is with no money down. Now, then we just given you example, quite frankly, to show you that there's not a lot of pain when you put money, when the veteran or the active serviceman makes a down payment. So now we're doing non-high cost area with a down payment, So that same scenario, they had 154 remaining. And just if we drop down to the next sentence. So for every $1,000, and we know 154 got them to 619, no money down. So for every $1,000 they go above 619, out of their pocket they put $250. That's at 25%. So for every 10,000, we go to the next slide, they make over 619. Down payment, 2,500. That's 25%. So let's just say we go to okay, 619 isn't doing it for them. For every $100,000 over 619, 25% of 100,000 equals $25,000. So what did this mean? We dropped to the last sentence. So they can buy in a non-high cost area, 719 sale price, with a 25,000 total down payment. So total down payment like 3.48%. So the whole point of it is when they do go over that 0 down, it's not super painful to raise that sale price by $100K, 25 out of their pocket, or $10K, 2,500 out of their pocket. So in my opinion, I do believe many active servicemen and many vets don't realize how easy it is and without a major burden on their cash to close a loan or make the down payment. And so that's a non-high cost area example. So this next example is, effectively in the DC metropolitan area, out to Spotsylvania County, out to Clark County. We are in a high cost area. So this, the example, the vet used more of their entitlement, 75, we just picked these numbers. So theoretically or hypothetically, 75,700 of entitlement. We're in a high cost area. So if you take 25% of the what is it, the 11489,825. So you take 25% of our high cost area max, 287,456. Subtract out the entitlement that they've already used, leaves 211,756. no money down times 4. So in this high cost area, when they've already used 75,000, they could buy no money down to 847. So, that's a long way to go considering they've already used it. But once again, you take 25% of the max amount, that 11489,825, that gives you the 287, less what they've used. That's what you have remaining, the 211 times 4 is your no money down. So like you don't have to remember the details of this, but I think bottom line is that, hey, you've used it before, we can still go a long way with you with a no money down payment. Okay, so now what we've done is we've come up with a high cost area with a down payment. Essentially, same guidelines as a non-high cost area. So we know they had 211 remaining. Doesn't change for each 1,000, 250 out of their pocket. For each 10,000, 2,500 out of their pocket. For each 100,000, 25,000. So what does this mean? We drop to the bottom line and get a 947 sale price with a 25,000 total down payment, representing 2.64% of the sale price. That's pretty good. And, effectively in this high balance, that would be considered a high balance loan. If we were comparing that to Fannie and Freddie, effectively, the VA rates are more competitive. Like today, in this market, quite frankly, since September 16th, this market, September 16th was our low point. September 18th, the Federal Reserve they dropped 0.5% for the overnight funds rate where the big banks borrow. Since September 16th, the rates have increased. We were at a low point, and that's pretty much, slightly each day, but it's been a little bit of a sour market. But I just pulled some rates yesterday just to give you some ideas. But literally, you could get a 6.5% 30-year fixed rate, 30-day close today on a VA, pretty close to a 0.5 point total, almost 0 points. 6.75, you're at 0. So 6.5 at a 0.5 point on a VA loan, not bad. Not bad. So even though the rates have been going up, the government, the VA, and the FHA prices, they're priced more aggressively. And the good news about the VA loan, if you have a 720 credit score, you're fine. You have a 700 credit score for rates. You have a 700 credit score, you're fine. If you compare, okay, I want to put 3% down on a conventional loan and I have a 700 credit score, unless you're a first-time home buyer, you're going to get blitzed because they have what's called these loan level pricing adjustments, and it's not pretty. You'd be in the 7s, assuming you're not a first-time home buyer and you're putting 3% down and you have a 700 credit score. On a VA today, 700 credit score, you get the 6.5 at a 0.5 point, 6.75 at 0 points. So more competitive in terms of rates, which is a good thing. Now, just an FYI, and you all know this better than me because you're out there daily. You follow what's on the market, what's not on the market, how many days it takes how many days it's on the market, days to sell. But this is, in our little world, this is what I'm seeing, is that sellers are being more receptive. Not in every situation, but they are being more receptive. We just closed a loan last week. It was a condo in Arlington, and they were asking like $795. They offered $783. Took the offer. And we closed it in probably, less than maybe 24, 25 days. And another thing too, so we can get this straight. You can close, your favorite lender can close a VA loan in 21 days. So that should never be an objection from a selling agent or listing agent. Oh, I hear it takes VA a long time to close. We can close a VA loan in 21 days. And we've been doing that in this in this heated market for a couple years now. So there is some thought out there with listing agents that it's going to take an extra 10 days or you need at least 30 days. No, we don't. And you can overcome that objection pretty easily when you have a buyer that's buying a VA loan. So I'd say 21 days or fine. So that was one example. Well, I'll give you another example as we move on to slides where it's more appropriate. And once again, in our 2-hour class, we dig into the details, a lot more than this class is all about highlights, quite frankly. So I think it's understood that a veteran, active serviceman or veteran has to be eligible to participate in the VA loan program. And we find that out through a certificate of eligibility. And we could pull it up online, and your favorite lender could pull it up online for your client. So that's very easy to do. And of course, if they're veterans, they've been discharged, there's a form that all of them have. It's called Form DD 214. That's their discharge document. I think we all know this another feature that Fannie doesn't have, Freddie doesn't have. Fannie Mae, Freddie Mac, no jumbo. Well, quite frankly, there are some jumbo that investors, very few that will allow a loan to be assumable, but normally the rates are not worth assuming. The VA loan is assumable at the note rate. So that's a great feature for your vet. That's a great feature. So any purchaser, not a veteran, but any purchaser can take over an existing VA loan with prior approval of the loan servicer. So that just means the lender who is servicing the loan, not necessarily the lender who closed the loan, because in many cases, mortgage bankers will resell their loan. So it's the lender who is servicing the loan will qualify them. And on these assumptions, they're relatively inexpensive. So, and we've seen, and I'm sure you've seen a few of them, where listing agents will advertise VA assumable loan. So that could be depending upon the rate, that may be certainly in this last few years, there's many, many, many thousands of VA loans that came in at 2.5%, 3%, makes pretty darn good assumable. So because they have to qualify through the loan servicer, the current owner is released from liability. So the new purchaser, disqualified, releases your client. Now they're listing their home, so it releases your client from liability. Now the VA benefit, their benefit is tied up until that loan that was assumed is paid in full. Now there may be, certainly in this area, can happen where a buyer that has VA eligibility will assume the loan and substitute their entitlement. And then that's a perfect world for the veteran who's selling their perfect world, because then they get their entitlement back also. So, but the bottom line is any purchaser who is qualified can assume a VA loan. If the veteran is fortunate enough to find a buyer who has VA eligibility and is willing to do a substitution, then the veteran gets their remaining entitlement back to use again. So obviously it's a benefit in increasing rate markets. You know, I haven't seen that many. Have any of you seen recently VA assumables? There was a while when we were like, I was hearing about it. Anybody seeing that? VA assumables?
Hey, Dave.
Yeah, go
Yeah,
ahead.
this is Mirfat Escoldol Banker. Yeah, I saw two of them in Maryland. I closed a lot of deals with military or veterans, so I saw like a couple listing, but one of my clients, she couldn't able to assume it because she doesn't have the cash. So she ended up just buying the house as a VA. So with using her benefits, yeah, because she's supposed to pay the difference between what the client own and the bank, and she doesn't have this one. But I work with a lot of veterans. I'm affiliated with a specific organization that I work with. So I do a lot of business in normally with, I'm going to say 95% of my clients is veterans or military personnel. They buy a lot in Maryland.
And Mirfat, you make a good point. It sounds good. Okay, they're assumable, but in since 2021, appreciation has skyrocketed. So then there may be a challenge with coming up with the difference. Or
yes,
in many cases, they can get a second trust with a bank, but it can be, you know, it can be a little more challenging. And I do think there are a number of sellers that may not be so interested in doing an assumable loan only because of the time. It just depends upon the servicer. You know, some servicers, this is what I hear, can turn it over in 60 days. But I hear from agents, other servicers, 90 days, some longer. So you'd really have to check with the servicer to see what their timeline is. And most, you see, in this current market, and once again, things could change. We know all markets are dynamic, but in this current markets, sellers don't have to wait for 90 days, and they can find somebody that'll buy it, settle in 21 days to 30 days. Okay, another benefit when we're looking, okay, what are the advantages doing VA over, say, agency loans, Fannie, Freddie? VA allows for common sense underwriting. Now that's a broad brush because you may say, well, what does common sense underwriting mean? They do consider, and we're not going to talk about residual income, but there's two qualifiers, but the major focus is on debt ratios, on ratios. And then once again, when I put this third sentence, ratios up to 62% debt to income, that means you take their housing expenses plus their long-term debt, and that's divided by their gross income. We as a company, New American Funding, will do 62%. You just have to check with your favorite lender. Now, the reason we stop at 62% is because we do, if you go to the bottom sentence, we do have to receive a DU or an LP approve eligible. And like I have not been able to get anything approved, any loan approved over like a 62.34 or whatever. But I mean, obviously, as a lender, well, the way we look at it, okay, yeah, we approved it at 62. And yes, do we believe that they're going to make their payments on time? And, you know, quite frankly, you know, ratio that's, you know, that was just determined by, you know, the agencies. We could take a look at a loan and we could tell through past history, officer, pension, military retirement, new job, you name it, perfect credit. My bet, these people who have been organized, served our country, make those huge sacrifices. You could darn bet we're going to do everything we can do to make a loan for them. Active service person, same way. These people go a heck of a long way for the good old USA. So, yeah, we're going to do everything we can do to make it work. So at any rate, flexible ratios. As a matter of fact, this summer, a young man, like he was 32 years old, no, just turned 30, bought in DC, former Marine, doing well, no debt. Now this one, this was unusual, but literally housing expense ratio 62, debt ratio 62, but literally. But that was unusual circumstances because didn't have a family, so wasn't carrying any additional expenses. Super bright, an economist. He flat out showed us how he could make the payment. And so we did the loan. That was this past summer. So it worked out for him. So if it makes sense, basically we could do it. So another, like, if we're comparing the VA to the agencies, friendlier with credit scores, a lot friendlier. And like the point I made before, you could go a long way with a 700 credit score. You can go a long way with a 680 credit score in terms of interest rates, but certainly possible at 600 to get them approved. Now, if we have a 600 credit score, is that DTI going to go to 62? Most likely not, but you could count on 50, 55 pretty easily. But that's a case-by-case basis. But 600, they're in the ballgame. I mean, as a company, we'll do 580 as a company, assuming we could get them through the automated approval. Alternative credit is okay. And then we just do these, like we said, we cover more detail the 2-hour class. But a bankruptcy more than 2 years old will be considered. Foreclosure more than 2 years old will be considered. So that, probably shouldn't have put in okay. Probably better said will be considered. I mean, it's not because they're bankruptcies 2 years in 1 day. That doesn't mean they're going to get the loan, but we can consider them. Yeah, I just wanted to throw this in for these active military people. And quite frankly, on Fannie Freddie, you could gross up non-taxables. But so if you have an active military person, their basic housing allowance and meals allowance can gross up. And that basic housing allowance, that could be a nice number to gross up. So meals can gross up by 25%. And then, they may have other flight pay, hazard pay. And then that very last sentence, not highly unusual, that will get a vet that, see, once they become 10% disabled, they're exempt from that funding fee that we know that we're not talking about today, but that's VA's guarantee fee. That's VA's insurance, the funding fee that can be financed back into the loan amount. So there is a funding fee, there is insurance, but they don't have to pay for it out of their pocket. But vets who have a 10% disability are exempt from that funding fee. Plus, their disability pay is also grossed up by 25%. So if they have 10%, most likely they're going to get a few dollars a month, and depending upon the extent of the disability, or closing the loan. Matter of fact, this Friday, a veteran, and of course we don't get into the details with them because it's personal, but 100% disabled. So we have a veteran that's 100% disabled, currently working at the Pentagon. So he has his military retirement pay, he's got his disability pay, he's got his Pentagon pay, his government pay. He's also, of course, exempt from the funding fee. Okay, so he's also exempt from the funding fee, but also in this area, and this is a rare bird, and you may not come into this, deal with this, but if you do have a veteran under those circumstances, they're also going to be exempt from real estate taxes. So they will not have to pay real estate taxes. Now they have to apply for it, of course, with the county, showing them that settlement sheet and also their 100% exemption letter, but do not have to pay real estate taxes. So, and see, then what we've been working on, quite frankly, is, okay, on all these VA loans, we have escrows. Okay, how are we going to figure out the escrows? So with him, with this loan, obviously we're not charging real estate tax escrows. So when it goes to the table, when it does go to the table, that's just less expensive because we're not collecting that on average 4 months of real estate taxes at the time. Now we do collect for the hazard insurance, but so it may, you never know. If it does come up, that's another benefit bonus that you could deal, like when speaking to that veteran who is 100% disabled, hey, you're not going to have to pay any real estate taxes. That's huge. And like I said, that's rare, but when it does happen, you could take advantage of it. But it is rare. It's something to keep in your pocket. Okay, another benefit. This is why we said flexibility. This is definitely, you cannot get this accomplished on a Fannie Mae or Freddie Mac, an agency loan. Cannot get it accomplished. So, and we've had a few over this past year where this came in handy, is that departing residents. So they're converting a primary to an investment property. A lease is not required. A lease is a 12-month lease. Like if it's a Fannie Mae, Freddie Mac loan, you better have the 12-month lease, and the security deposit and the first month's rent's got to be cleared into their account. On a VA loan, that's all we need is a statement from the active service person or the veteran that they intend to lease their property out within the next 90 days. They intend to lease the property out within the next 90 days. Okay, then what's the next step? We normally, what we'll do is get a CMA from the realtor for a rental, or if they can't get it, we'll get an appraiser to do it. Like the last one we did, our underwriters just accepted a Zillow rent. Of course, it was pretty well qualified people. So bottom line, that's all that VA wants to know is the rental marketable? Can you rent it in 90 days? And the answer is yes, yes, and yes. Most likely you're going to be able to rent it in 30 days. And then some type of an idea what it could rent out for. We take 75% of that and give them credit to offset their housing payment without the inconvenience of scrambling around to get a 12-month lease. So That's pretty good. I mean, I think that's a major, major benefit over the agencies. So are there any questions on converting a primary to an investor property? Have any of you seen that, done that with your borrowers? It could come in handy, and it takes pressure off. Okay, and then also what it does is, hey, we could get you into the home without you having to, without you having to lease your property out. So let's, like, that may get them more focused on buying without the hassle of, okay, what are we going to do about a lease? So I think that's very strong, very, very strong guideline, very strong, flexible guideline that VA has over the other agencies. Okay, I'm starting to sound like an old record that keeps repeating, like those old early 60, 70 songs where they repeat every other sentence, like the Beatles do. Probably many of you. Do any of you ever heard of the Beatles? You've had to. I'm sure you've had to. But at any rate, old story but true story. Seller concessions, high advantage VA over Fannie Mae, Freddie Mac, high advantage. Okay, so this is what VA will allow, believe it or not. Seller can pay all usual and customary closing costs, including up to 2 discount points. That means initially you could have a loan with 2 discount points. They can pay all closing costs, all prepaids. So they've done that. Okay, they paid that. Okay. In addition, so they've already paid all closing costs, prepaids, and escrows. In addition, the seller could pay an additional 4% of the loan. It is of the loan amount, but the loan amount's pretty close to the sell price. So they can pay additional 4% of the loan amount, excluding prepaids, meaning prepaids and reserves. So let's just let's hypothetically, let's just say we have a $500,000 sell price to keep it simple. So they've already paid all closing costs, prepaid. So then we would take and zero down, and let's say they were exempt. So 500 loan amount. So 4% of 500,000 is $20,000. Okay, let's say prepaids and reserves, say $3,000, which I think we covered. But that means they could use $17,000 for about anything else. The only guideline is they can't receive cash at settlement. Okay, but what can they receive? Okay, an example. And then, quite frankly, you might and I get it, you might say, well, who in the heck's going to do that? What seller's going to do that? Good point. Up until a couple of weeks ago, the last one I did like this was like 2018, 2019, but something to keep in your pocket. We have one coming up, believe it or not. Seller was initially paying $10,000. Now they're paying $20,000 on a VA loan. We have $16,000 in closing costs total. They can't get cash back, so they have a 30-day American Express card that we're getting the card and the credit card number. And at settlement, we're going to pay like $4,000 off of a down on their 30-day American Express. And then let's just say they have a $2,000 balance. They just get a $2,000 credit. So or they could run out and purchase a Home Depot card, and then we could put the $4,000 on the Home Depot card. So yes, not going to happen every day. Between 1988 and 1993, that's how sellers and purchasers would get, sellers and buyers agents would get the listing agent, buyer's agents, selling agents would get together, figure out, hey, how do we qualify this person? We'll pay off debt, we'll pay off a student loan, we'll do this. And then they get their house sold. But this is when shelf lives were 60 to 90 days. They weren't 3 days or 5 days or 10 days, but something to keep in your pocket. This one is a fluke. Like the last one I did was 2018. This one just happened, just worked out perfectly for our veteran. And it was all about the home inspection. So they got what they wanted. So our veteran, basically they made a $20,000 earnest money deposit. So they have $16,000 in closing costs. We did a 0-point loan. Pop get 4 back. They get their $20,000 back in earnest money, and then 4 additional because the seller paid $20,000 in closing costs. But once again, I would keep this in your pocket for a different market or for homes that have these shelf life. So you never know, that may be a home that has a long shelf life that they're anxious to sell. That could happen. Any questions on that? Okay. I'm checking and it looks like all eyes are still open. So I say that's a good sign. That's a good sign. Okay. Quite frankly, Fannie Freddie appraisals, I think I don't have to tell you this. That's where Fannie and Freddie have the advantage. But these are a couple items that to be aware of that makes the VA appraisal a little more appealing. Okay. Number one, Tidewater Initiative. And this is done prior to the VA appraiser issuing the value, issuing an opinion of value. This is all this means is that the appraiser goes out there, they have the contract, they don't see it. They don't see how they're going to get the value. They're obligated to notify us, the lender. Okay, we don't see it. That gives us, all parties, gives us 48 hours to respond back to the appraiser. Well, this is how we arrived, and that's all parties involved in the transaction could do a CMA, do three sold and settled, but go back. This is how we arrived at it. So then we get that back to the appraiser. Now, believe it or not, I've seen at least a few where that's made a difference, where the appraiser has come in and either come at the value or met somewhere in between. But while I'm thinking about it, probably in the many that we've done since 2021, it's a rare bird when we have a value issue on a VA loan, a rare bird, similar to Fannie Freddie. Like, it's been amazing. There were years, and probably up till 2013, when you could count on a VA appraisal coming in low. VA has done a huge turnaround on that. They've done a huge turnaround. And I think that the appraisers get the message. Hey, don't exclude these hardworking veterans active. So don't exclude them from the market. like those unintended consequences. Okay, let's protect the veteran, but then on the other hand, they can't win a contract because the Veterans Administration is protecting them. So so the Tidewater Initiative, that can work. That can work. But that's prior to an opinion of value. Okay. A reconsideration of value, also called an ROV, that's after the appraisal comes in. So basically, the veteran can request in writing. They would go through the lender. So the veteran, the active service person, goes to lender. The veteran initiates it. It would be important to have sole comps, but on this reconsideration of value, they will take a concise, what's at the bottom of this page, they'll take a concise narrative from the borrower. Obviously, they're going to need help from the agent, assuming that, one, we're assuming that the veteran wants a contest value. If they don't, they don't. If they do, there's a mechanism after the appraisal to contest value. So they must have that concise narrative. And obviously, they have to be making points of why their narrative, the points they make in their narrative, is more significant, it's more realistic than how the appraiser arrived at value. So it's almost like doing a CMA. You can do a CMA, it's just not required. My opinion, I would do the narrative and the CMA. So, that helps. That helps. Now, we all know about the mandatory clause. Like, it's there. So we all know about that. But see, having this reconsideration of value, knowing about the Tidewater Initiative, this could help you when you're presenting the contract to, okay, relax seller, relax listing agent. And like I said, recently, we had mentioned the 795 at 783. We're closing one 20,000. They did do. They went at the sale price, but $20,000. Now those could, those are flukes, admittedly, but the market appears to be more receptive today, accepting VA contracts. So just somehow, these were all highlights, just comparing like the benefits, the opportunities, the advantages that a VA loan has over the agency loans. So at any rate, hope this was beneficial to all of you. If you want to dig in, I'd be happy to. You could text me or call me. If you have any specific questions, we'd be happy to answer them. So long story short, a lot of advantages over the agency loans. That would be a long story short. But so at any rate, thank you for attending. Hopefully it was valuable for you.
It was very valuable because this is an unbelievable tool. I know I'd be advertising it. All right, guys, have a good day. And I'm going to put this, I'm going to definitely tell you where I'm going to put this recording. It's going to be on Dave's instructor page at cindybishopworldwide.com and also on the member site. And you sign up for that. Everybody signed up for that. It's at cindybishopworldwide.com to upcoming events. There's a banner that pops up. Click on it, put your credentials in. I think you sign up with name and you create a password. So, because it protects our copyright. And then it's generally under Real Estate 101 for something like this. Okay.
Good deal. Thank you.
Have a great day,
Thank you, Dave.
guys.
Thank you,
Thanks,
Ken.
Dave. Hey,
Thank
you're
you.
welcome.
Guys, bye-bye.
Bye.
Thanks.